So we are live now. Nice, sir.
Okay. Thank you, Dipanshu. Good afternoon, participants and eminent speakers. Uh, Thank you so much for joining this important webinar. It's a part of that capacity building program of ASSOCHAM MSME Council. We have been doing many activities under MSME development councils, and there are capacity building program. There are some surveys, roundtable discussions, policy advocacy, as well as technical sessions we are holding over the period of uh, over the years. This time, we have also launched MSME development index survey as well. It will start from 25th February to 25th March. Then we would be releasing the results by first week of April. Uh, this is the one of the engagement or activities where we are trying to make aware of MSMEs to use the efficient way of foreign exchange trade. Therefore, this is the first engagement. We will keep continue of many engagements over the maybe around 6 months, coming 6 months, and we will be doing in different physical programs as well. One of the sessions. With this, we have eminent experts into the particular field, foreign exchange, forex, and we have a wide range of MSME participation as well. And this recording also we will be circulating to the all members, so that the inputs from the eminent experts can be used in different purposes. We have today speaker from Mr. Naveen Goyalji. He heads MSME banking of IndusInd Bank. We have Amit Batraji. He heads financial marketing sales and solution of business banking, IndusInd Bank. We have Leela Nanji. He is the general manager and heads treasury of South Indian Bank. We have Ritesh Victor, co-founder and country director, market risk advisory, TPO Myforex. We have Vipin Mahajan, director, knowledge and infrastructure. We have Abhinav Gupta, CFO, Trident Limited. We have Sushil Sarveji. He is the co-chairman of our MSME Development Council, and he is a MD of Core Energy India Limited. With this word, now I would like to invite Naveen Goyalji to share his thought on this important topic. Naveenji, over to you.
Yeah, good afternoon. Thanks, Nahid. Thanks for a nice intro, and thanks for inviting us in this program. Happy to be there. We at IndusInd Bank, basically, MSME is one of the major focus areas for us. In fact, we carved out this unit specifically to focus on MSMEs. And as the topic is today on foreign exchange, and foreign exchange is one of the, very specialized and sensitive kind of topics. So that's why we as a bank have created a specialized teams at central level, zonal level, regional level also. We have a centralized treasury, then we have zonal treasury, traders, and then we have people at the regional and branch level also. Then we believe, MSME being a small kind of client, generally they are ignored, in terms of size. But we firmly believe that they need a special assistance, special handholding, and special kind of servicing, which is niche, which is required for these MSMEs. That's why we have created trade and specialized treasury teams across India. So we have Amit Batra from our GMG, we call it Global Market Group team, who will take it forward. I won't take much of time. I'll just introduce Amit, and we have a trade team also online. And we have prepared a small presentation to showcase it to you all. And we are happy to address post that. That's it from my side, Nahid. Just a small, heads up.
Thank you, Naveenji. Now I request Amit Batraji to take over.
Yeah. Hi. Good afternoon, everyone. Thank you, Nahid and Naveen sir, for setting up the tone for the entire discussion that we are going to have for next 1.5 hours. So rightly said, so that we are here, to discuss the evolving trends and significance of FX management, specifically with respect to the MSME business in India. So if I talk about MSME business, I think this business contributes almost 50% of exports of around $500 billion that we do through India on a yearly basis. And to give you a glimpse, around 45% of India's industrial employment is being generated by this sector. So, you know how vast this sector is and why there is a need of specific focus, to promote the MSME business, not only from the Indian economy perspective, but as a overall. So in IndusInd Bank, we do have a segment which specifically cater to the MSME segments. The clients which are qualified or eligible to be a micro, small, or a medium enterprise customer. The segment is headed by Mr. Naveen Goyal, and we do cater to all type of services, including your liabilities, your assets, your fund-based, non-fund-based limits, and the most important agenda for today, that is your foreign exchange management. So for that, I'll just share the PPT which we have prepared. I hope this is visible.
Yes,
Okay.
Amitji, it is visible.
Yeah. So when I talk about international trade or the FX management, the three key parameters comes to my mind or even anyone else's mind. That is, what is the exchange? What is the foreign exchange risk? What are the various factors basis which the exchange rates of different currencies move up or down? And how do we hedge our currency or the exchanges rising out of these international trade transactions? So to my mind, there are two type of risk which are eminent in a foreign exchange business. That is, one is your currency risk, be it from the payable side or a receivable side in terms of foreign currency, and second is the interest rate risk when we talk about lending being done in foreign currency. So how do we mitigate this? These risks could be through various hedging techniques. That could be, most of us would have actually entered into such transactions in day-to-day transactions. That is your FX forwards, then options, and a specific type of tailor-made product, that is your derivatives. Now coming that why the exchange rates actually move. So these are various key parameters which actually affects the exchange rate of an economy. So today is a very specific day. So today we had the RBI MPC minutes coming out, where RBI kept its policy stance as accommodative, and they kept the rate of interest at the same levels, that is 4% of repo and 3.35% at reverse repo. So that means RBI as of now is looking to focus on growth rather than to contain the liquidity or the inflation. So the stance was very clear from RBI perspective, because if you see the inflation range from past 6 months or so, July, it is somewhere between 4.49 to 5.59%. So 5.59% was the last trend. And if I talk about the current account deficit in terms of Indian aspect, it is somewhere close to $9.6 billion. GDP growth, which RBI predicted today, is somewhere close to 7.8% real GDP growth that is predicted for financial year 2023. So this aspect, or I would say the inflation numbers, the trade cycle of a country, that is your balance of payments, or the commodity prices. In terms of Indian context, if I talk about crude plays a very major role in all these balance of payments, because we have almost a contribution of 28 to 32% of import bill, which is pegged to crude imports. So any unfavorable movement in these commodities do affect our import bills. So Indian economy per se is an import-driven economy, where we are net payables as compared to net receivables. I'll take an example of Chinese economy. So at times, this is also a key factor where the central banks come in and try to manipulate the exchange rates. So what the Chinese bank generally do, the People's Bank of China, they try to buy the assets which are denominated in dollar. So in a way, they're trying to lower their Chinese yuan against dollar, and in a way promoting their exports, because China is primarily a export-driven economy that we all know. So these are certain parameters which typically affects the exchange rates traded globally. Could be your ratings. So if I talk about sovereign ratings, which are being governed by agencies like Moody's, Fitch, DBRs. So if I talk about Indian context, we have a stable outlook with a rating of Baa3 by Moody's and triple B minus by Fitch with a negative outlook. So all these parameters plus your capital flows, and one more aspect I would like to touch upon before I move further is your foreign exchange reserves. So if I talk about in Indian context, we are all sitting close to 640 billion odd dollars of foreign exchange reserves, ample ammunition to contain any sort of volatility in one or the other direction. So if you see today, dollar has moved beyond 75 once the RBI governor's speech was on during the day. So all these events, when there is a volatility in the market, the central banks come in and try to soothe the or contain the volatility through this foreign exchange reserves. Now coming to the the most important aspect in terms of MSMEs, if I talk about, is how they can manage their foreign exchange risk, be it currency risk, that is the conversion of one currency to another towards their payables or receivables, or the interest rate risk arising out of their loans, which are primarily denominated in foreign currencies and are typically floating loans, which are linked. Historically, they were used to get linked through LIBOR. Now, post 31st December 2021, the LIBOR has ceased to exist, and there are new benchmarks which typically we call it as ARRs, that is your alternate reference rates, which is SOFR, SONIA, Ester, all these benchmarks which are now in picture, which are now in implementation for your foreign currency loans. So coming to the hedging parts, so the basic, I'll take an example here before I move into the product, actually, to give you a glimpse. So let's take an example of an exporter client where he has got receivables in dollars. Now he has got a payment cycle of 90 days. So after now let's assume today when he's exporting the goods to the foreign country, let's say US. Today's rate for dollar is, let's say, 75. So after 90 days, when the receivables actually hit the Indian bank counters, he is not sure whether the dollar rupee rate will be 75, will be 80, or will be 70, because there is uncertainty in the market, and he is not sure, the client is, the exporter is not sure whether the rate will hold good for these 90 days or not. So there is an element of risk which is very evident here, is involved in this transaction. How? So now assuming when the receivables actually comes and the dollar rupee rate is trading at 70 after 90 days, he will have to get the realization done at 70 rupees instead of goods being sent at 70 when the dollar was at 75. So there is an evident risk that even the capital invested in the doing this particular business transaction is at risk, because you are getting 5 rupees lower conversion rate as compared to the costing or the cost rate at which the shipment was done. So to take care or to counter these type of situations from both import or export perspective, or be it inwards or outwards, a client can get into a plain vanilla forward transaction. So these typically are transactions where your future rate is predetermined for a predetermined amount of foreign currency, which is for a predetermined period. So this period can be a single date or could be a window of 30 days. That means the remittance can be realized on a single day, or I can, so as per RBI, we can give you a 30 days window where, so again, I'll elaborate. So let's assume after 90 days, that means in May, we are expecting the receivables to come to our bank. So, but the client is not sure whether it will be of 1st May, it will be 7th May or 30th May. So we can give a flexibility of 1st to 30th, that is an option window period to the client to realize his export receivables, which are booked against this forward contract. So it is basically a typical plain vanilla hedging tool available to specifically, all the clients, but it is a, very effective tool available to MSME piece, because this does not, contain much risk. Only one typical drawback, that is the opportunity cost risk. That is, so that means, now assuming in as per this example, I have done a forward contract at 77 rupees per dollar against 75 rupees. Now, if on that particular day the dollar is at 80 rupees, that is only the opportunity loss that client will bear. Otherwise, if the payment comes on time and the realization happens at 77 rupees, client is bound to get what he has, entered into. So he is fully secured while entering into such forward contract. So it is one of the, high selling product in MSME space. So we as a bank, typically advise all our customers, be it from import perspective or export perspective, to enter such contracts to hedge the currency, typically the currency risk arising out of the transactions. Now, just a flavor of how these forward rates are, quoted in the market. So forward rate is a combination of the spot rate plus the premium. So premium is nothing; it is basically differential between the interest rate of two economies. So assuming the currency pair as dollar rupee, so now the current rate of interest in India is prevailing in India is 4%, and vis-a-vis in US it is 0.25%. There is a band of 0.25 to 0.5%. So there is a differential of, moving your dollars to rupee and rupee to dollars. Hence this differential, translates into the forward premium, and this forward premium is being added in your spot, and you arrive at the forward rate. So whether you are an exporter or whether you are an importer, the premium will always be added to your spot rate. So this is just a flavor that how these forward rates are being quoted, and these are typically influenced by the demand and supply in the market in that particular bucket. So in that particular bucket means, let's say there is a possibility that in 3 months there is a high possibility of getting more receivables than payables. So depending on the forward curves move accordingly. And one important aspect that I would like to highlight here is these forward rates in nowhere predict that this is going to be the future current rate on that particular day. So this is a very important aspect. Now coming to second thing, that is option. It is just an extension of forward contract. So to put it in a layman language, it is typically a insurance of your foreign exchange transaction. So how an insurance cover works? You pay a premium for your insurance policy, and if any unfavorable event happens, you exercise your insurance. Similar on the similar lines, this option contract works. It is an extension of forward contract where your the future rate, which we call it as a strike price, your maturity date, that is your expiry date, is prefixed like a forward contract, but only with a flexibility, that is, it is the right of the buyer to actually exercise this insurance or this option or not. And while doing so, he will have to pay upfront premium. That is the insurance cost. That means he has to pay a premium to buy this option. So while if the client is an importer, he can buy a call option, and if it is an exporter, he can buy a put option. So I'll quickly run through the difference. That will give you a better clarity that how these basic hedging products work for an typical.
Sorry to interrupt here. Yeah, you please wrap up quickly so that.
Just 2 minutes. I'm just done. So if you see, I've taken an example of an exporter client where you have taken an forward contract as well as an put option at 76.75. So if you see, the major difference is if on maturity, if the spot is at 75, so you will sell the forward contract at 76.75 and you will exercise your option. But if in case the market is worse off, that is, if the spot on maturity is at 78.50, forward come what may has to be settled because it is an obligation. While option, as I've just mentioned, is an buyer's right because he has paid an upfront premium in that particular product. So he will not exercise the contract and he will purchase or get the receivables realized at the market rate. So that is the benefit that MSME client will garner while choosing an option. And lastly, a typical derivative product is in terms of MSME space, if I talk about, it is linked to your the foreign currency loans. So a loan typically will have two components. One would be your principal, and one will be your interest. So typically these loans are floating loans linked to your MCLR, LIBOR or ARRs. So why we can hedge these type of loans through a derivative product. Typically it is called as interest rate swap, where your even interest liability is fixed, plus since you are an exporter or an importer client, so typically this loan is for exporter clients, so you have got receivables to take care of your principal EMI, whereas the interest can be fixed to mitigate any sort of risk arising out of the transaction. So that is it all from my end. Thank you.
Thank you so much, Amit ji. Now I request Leelanand ji to take over from here. Leelanand ji, over to you. Thank you so much.
Thank you, Nahid. I think Amit has covered quite well all the products which are available. I'll just, I don't want to repeat all those things. What I'd like to see is that MSME typical, how a typical MSME customer works. It is all, mostly it is driven by the owner of the company, who is mainly busy into his regular business activities. There, what we have seen is in MSME, typically the foreign exchange aspect comes a bit a lower side, not on the front end. That is where we have seen many of the times they end up doing a wrong hedge or not doing anything at the time. Just to give an example, what we have seen in the past, say in the past 2 decades, we have seen currency markets moving in a volatile. Sometimes it will be up and sometimes it will be down. Even if you see in the last 2 months, where we have seen rupee move up to 76, 30, 40 levels, and it came down to 73.80 also. Typically, what we have seen is MSME customers, suppose to give an example, when rupee crosses 75 or 76 rupees, the importers will rush and come and try to get their payables, because out of fear, where they must have not focused on the rate till the time it reached a particular alarming level. That is the time they will come and typically buy the dollars where they are not supposed to do it. And same way, when it that is out of fear, they will be doing it. And same importer, when rupee has appreciated and moved before, say below 74 also, they will not come and hedge, expecting that rupee will move further, appreciate to 73, 72 and all. This is out of greed. Similar thing happens with exporters also. Majority of the time, exporters very reluctantly try to hedge when rupee is depreciating. They are at 76 levels and all. They expect it to depreciate further, and they don't do the hedging. Where like large corporates who are having a proper treasury and risk management system in place, those are the people who will be trying to take advantage of the markets. So this, we cannot blame the MSME people, because they don't have the bandwidth for them to look at the market so closely and take advantage or take a right call. So what at SIB South Indian Bank, what we are trying to do is that we want to in the sense engage with the customers in a way where they will be able to hedge their receivables, and we'll try to understand the business of the MSME. And we'll always suggest to have a proper risk management policy. Even the turnover is as low as $1 million per annum, or even 10 million, 15 million. You need to have a policy where we suggest is that as and when the order is booked, MSME customer, especially exporters, they should take advantage of the premium and they should book forward contract minimum for 50-60%. Given that rupee is always on a depreciating mode, minimum is 50-60%. Even if the customers they can go for 100% export also once the order is confirmed, confirmed orders. In anticipated exposure, we don't suggest them to go for the full hedge, because we know rupee can move in both the directions. So typically, from our bank, what we have been guiding people is that how you can remove the emotional factors, these greed and fear factors, while getting into the foreign exchange markets, because markets are quite volatile. Unless you have a proper risk management policy in place, you will not be able to take advantage of the markets. What we try to call it as a consistency is the key for the any kind of a foreign exchange hedging. Even we can put it as a SIP kind of a thing, where you are managing your wealth in a mutual fund by doing a systematically investing in a SIP. Typically for MSME also, you can get into a Forex SIP kind of a philosophy, which we'll be able to explain in detail when we meet some other customers. That is what we have been suggesting. So that where, irrespective of the market conditions, in a systematic way, the exporter will keep hedging his receivables on a regular basis. Here, the key mantra is the discipline. Discipline and consistency. People should not get swayed away by the market rates. Typically, one more thing what we have seen is, majority of the customers, when they start engaging with them for the forward contracts, they say, earlier we booked the contract, but we have lost. What you lost, what as Amit said also, what you lost is only the opportunity. But nevertheless, that should not deter you from going further hedging. If you don't do, that is the time you will be missing the entire forward premium. Typically, if you see, for difference between interest rates of INR and US dollar is always close to around 4.5%. Sometimes it was there 5.5 also last year. That is the premium. If you do, that is where I'm again repeating it. If you consistently do the forward contracts on a systematic way, you'll be on an average realizing a forward premium of 4 to 4.5%. Vis-a-vis, if you see the actual depreciation, sometimes rupee might have in bad years, it might have depreciated by 15-18% also. Sometimes it has appreciated by 5-6% also. Average depreciation, what we have seen historically, is much lower than the forward premium. Only here, one thing each and one every exporter need to keep in mind is that they should not stop the hedging when they see when rupee suddenly depreciate to 76. They will expecting that rupee will go to 77 and 78. That is the period they will stop it. Those kind of this thing, market dynamics, you should not get into. You should have a proper risk management policy. As per the policy, as and when you get a contract, you just hedge it, especially for exporters. Importers, they can follow a different mechanism where they will be hedging the near term, near to say 1 month to 3 months, because importers' premium paying is an additional cost to them. There also we have a different kind of mechanism how it can be hedged. So this is the things MSME people need to keep in mind. They should, while they may not consider this foreign exchange entire portfolio as a profit center, they should not make it as a cost center also by not doing proper and right time of hedges. This is where we will help majority of the MSME. As a South Indian bank, our asset book is close to 50 to 55% is MSME only. That clearly shows what kind of importance we are having in our entire our SAB ecosystem. And we have treasury sales team spread across the country, and we have branches close to 900, and our sales teams also quite close to 30 are available across the country. So what we request is that any customer having any kind of further discussion, because given the limited time, we'll not be able to discuss each and every strategy in detail. But nevertheless, we are more than happy to engage with you. You'll be getting our credentials from our ASSOCHAM team. You can always reach out to us. We will definitely help MSME, because we have been doing and we have been able to increase the, in the sense, bottom line realization at least by 1.5% by giving a proper strategic solutions, both for exporters as well as importers. That's it from my side. Thank you.
Thank you so much, Lilanji. Thank you so much for your valuable input. Now I request Ritesh Victor to take over. Ritesh, over to you.
Yeah, thank you. Thank you. Good afternoon, ladies and gentlemen. Good afternoon, Amit. Good afternoon, Nilanjan sir. Afternoon to every one of you. I would ask Dipanshu to relay these slides. Dipanshu, can
Yes,
you?
sir. Yes, sir. Yes, sir.
Yeah. Yes. Can you just do full screen on this? Okay. Okay. So thank you, Dipanshu. Thank you. I will just request you to navigate this for me. Good afternoon, everyone. A warm welcome to each and every member to the world of Myforexeye. Obviously, we are talking about the evolving trends in Forex. Next slide, please, Dipanshu. what we want to indicate to each and every MSME and each every participant is a few facts about how to manage forex risk better. Amit covered it with the kind of derivative instruments that are available, that are very freely available. You can do it with your banks, you can do it on an exchange as well. And Aliranand sir also gave some wisdom and understanding in terms of what should typically be a risk management policy. So I have some common points, but I will eliminate those common points and discuss more of the insights and wisdom that we can provide. Okay, there has been certain particular patterns of the exchange rate that has moved in the last 20-21 years. We'll try and showcase the research that we have done that has led to a specific conclusion why exporters should hedge. Okay, so I'll come to it one by one, and also for the benefit of MSMEs, I will also want to invest a few minutes on understanding your forex transactions. Okay, so next slide, let me just get through the agenda. So the first agenda is about how to manage forex rates because this is the most critical element. This is what hits your top line and bottom line, the conversion, the exchange rate. So we need to understand what is exactly this exchange rate and what is the particular or exact transaction type that I have. Then how to hedge, what is the instrument to hedge, what are the risk management instruments, how do I hedge the fluctuation, the exchange rate is very volatile. We have seen movement, quick moves to 76 plus and then move back below 74. Historically, obviously, we have seen a lot of volatility. So what are the instruments to hedge? Amit has covered it, so I'll also just brush through it. I'll not invest too much of time on it. I'll probably invest more time on point number 3 and 4. Okay, 3 is a particular guidance that we give to all exporters. It is actually a misguided conclusion by exporters that rupee is always weakening, so we need not hedge. Okay, so we will prove with actual facts and figures that actually it makes a lot of sense to hedge rather than keep your positions open. Okay, and on the fourth part, we'll also discuss about how to optimize your interest cost on your export credit, on your export funding. So one by one, right, managing forex rates. Let's come to it. Now, each and every one of you, MSME exporters and importers, whenever you do a transaction, please understand what is your forex transaction. Okay, what is the particular transaction type that you have? When I say transaction type, I mean that remember the exchange rates are quoted. The benchmark that we see on the market in terms of exchange rate is something called the spot. Okay, and spot is the rate that is quoted and traded today, but settled 2 days later, which means debit or credit, that is the settlement of the account, happens 2 days later. But typically, what happens is when you do a transaction, you want the debit or credit to happen today. So you do not take the spot rate, you need the cash rate. So spot is not applied when the settlement happens today. Okay, so understand the concept of cash. The cash rate is derived by just subtracting a component from the spot rate. Okay, so majority of the transaction that happens in India are cash. So understand cash is not spot. There is an adjustment to spot to arrive at the cash rate. Similarly, if you want the trade to happen today but settle tomorrow, there's something called TOM, which is like T+1 settlement. Similarly, similar to cash rate, there is a TOM spot that is adjusted to the spot to arrive at the TOM rate. And any settlement which is beyond the spot date, that is T+2, is what we call as the forward rate. Okay, so any settlement beyond T+2 is forward rate. So whenever you're doing a transaction, understand what is your transaction type. Okay, and why am I insisting on transaction type is because to get the transparency of rates for all your conversion, you need to take the first step, and the first step is to understand whether I'm doing a cash or am I doing a TOM or am I doing a spot or a forward, because depending on that your computation methodology will change. Next slide, please. This is a small slide where I have given how the exact rate is determined. Okay, and this is, there's a spot for cash. There will be cash spot that is adjusted. Then obviously there's something called bank margin. Bank margin is the compensation that you pay to your counterparty, that is the banks. for all your forex conversions. Okay, so whenever you're doing a conversion, you give a bank margin to your bank, and that is a cost to you. So you just need to make sure that this cost is fixed and not variable, and it is transparent. For obviously exporters, the bank margin is reduced, and for the importers, the bank margin is added. So this is a very ready reference, a very quick guide to all MSME exporters and importers as to what all are the variables that will be used for your particular transaction type, whether it is cash, term, spot, or forward. And if you do a forward, obviously the concept of forward premium will come in. So forward premium will be added to your spot rate, and then depending whether you're exporter or importer, margin will be subtracted or added. So keep this as a ready guide. Understand the transaction type, understand the components, what goes into the calculation of the rate, and once you understand that, you will understand what is the net rate that is applied to you. Okay, next slide please. Now, again, no offense to any banker here, but this is something which common complaint that I get from a lot of MSME exporters and importers in India, that they feel that the banks are overcharging in terms of foreign exchange rates. The only suggestion that I have to such people is just understand how the rates are quoted. Obviously, there is a lack of transparency and limited availability of spot rates. You don't get spot rates or live forward premiums on public platforms. You get it on terminals, and these terminals are very expensive. But if you understand the kind of transaction that you have, and if you understand what is the bank margin that you need to pay, ensure that you understand it and that it is a cost to you, and you just need to ensure that the cost that you're paying is fixed and it is not variable. Another challenge with MSME exporters and importers in India is that they are unable to take advantage of the exchange rate volatility. There are smart systems that are there in the market which you can use. You can put alerts in systems. We have a mobile application. You can use our mobile application as well. You can put alerts in the system on the application that will help you in terms of capturing market levels. So if you want to take benefit of the volatility of the exchange rate, for example, let's take the market is at 74.75 now, and you want to do conversion at 75. An exporter wants to do conversion at 75. So you don't have to keep looking at what the rates are. You can keep an alert in the system that I want to do an export contract, or I want to do an export selling of dollars if the spot touches 75. So you can keep an alert in the system, and the system will notify you. The system will send you a app notification. The system will also send you an email. So the system is smart enough to work for you. So instead of you keeping a tab on the market every day throughout the day, because all of you, I'm sure MSME exporters are real busy people, so you cannot have the focus on the market throughout the time. You can use the alert systems to tap the market levels. Understand one more thing, small thing. Cashpot, understand that cashpot is deducted, so it is a benefit to importers, and it is a cost to exporters. So understand that cashpot concept, understand the transaction type, try and get the bank margin fixed, and don't keep it variable. This will ensure that all your transaction costs in foreign exchange dealings are kept at the minimum. Next slide, please. Okay, the instruments are something which, again, next slide, Dipanshu. Instruments is something which Amit has covered. So I'll just give you a quick run through. There are multiple categories of instruments. The first and the simplest is what we call as forwards and futures. Forwards are done with banks. Futures are done with organized exchanges. Even though they are very similar contracts, there are distinct differences as well. But it is a simple contract to fix your rate for a future delivery. Just understand, it's a simple contract to fix your exchange rate for a future delivery. So once the rate is fixed, you do not have to worry about the volatility. Wherever the market goes, your rate is fixed. So it's a kind of an obligation. It's an obligatory contract. Forwards, as I said, are done with banks. You can do it with your counterparties. Any bank that you do with your Forex transaction with, you can do forwards with banks. You can do futures in NSE, BSE, which are organized exchanges. You have to just open a demat account and you can hedge or trade on the currency using the futures prices on the exchange. Okay, so forwards and futures are the most simplest form of risk management instruments. I'll quickly cover this, not spend too much of time. Amit has covered this. Next slide, please. Options are an extension of forwards. It gives you a flexibility in terms of that it gives you a right and not an obligation. So you not only fix a rate, but you get the upside as well. So if the rupee, you have taken an option at 75 and on maturity, the market goes to 76. So you just do not exercise your option. You let the option expire unexercised and you capitalize on 76 levels. So there are puts, which is right to sell for exporters, and there are calls, which is right to buy for importers. But understand, unlike a forward, this comes at a cost, which is called the option premium. So you have to pay an option premium. Obviously, the concept of insurance has evolved from option pricing. So this is not a free instrument. Vanilla options comes with a cost, unlike a forward, which is free. You don't have to pay a cost to buy an instrument. Okay, so options are derivative instruments, just slightly advanced and better than forwards. It gives you the upside capture of exchange rate movements. Next slide, please. The other instruments to hedge are currency and interest rate swaps, where you have long-term tenures of your repayment of long-term currency loans. If you have a long-term loan or if you have a long-term frequented liabilities, then you are exposed to currency risk and you are also exposed to interest rate risks. So how to hedge the currency and interest rate risk are using through swaps. You have interest rate swaps, you have currency swaps. You can hedge only your principal, you can hedge your entire currency as well as interest rate. So there are various options in the market which you can do. But these are all the third category, what we call as the swap category, where you can hedge both currency as well as your interest rates. Okay, so these are relatively complex structures, and whoever wants to dive deep into this are most welcome to reach out to us. We will help you in understanding the structure and also help you in fairly pricing these instruments. Right. Now, this is something which I want to invest more time on. Leelanand sir had just given an indication that you should hedge. And it is certainly that all exporters and importers should hedge. But we did a study for the last 21 years, and it's a very simple research. It's no complexity involved. It's a very simple research which concludes very emphatically that exporters should hedge. And this line, this sentence that I've written in blue, USD INR is always gaining, hence exporters need not hedge. This is a kind of a misguided conclusion. It's a myth by exporters. But the reality is true. You know, a few years back it was 65, 66, now it is 75, 76. So it is true, but it is not the full picture. So we still tell that forwards are a very effective risk management tool. Next slide, please. So the question that I ask is, whenever an exporter comes and emphasizes on this misconception, the question that we ask them is, does rupee always weaken? Not necessarily. It weakens most of the time, but it gains also. What about dollar INR forward premiums? Are we looking at the full picture? Okay, so these are the counter arguments that we give to any exporter who come and tell us that we need not hedge. Dollar is always gaining, so we need not hedge. The importer should hedge. So we will, conclude with facts and figures what the reality is. Next slide, please. You know, we did a very simple research. We did a very, very simple research for the last 21 years. We started from the 1st of Jan 2000, and what we did was on every working day, we took 3 forwards. We took a 3-month forward, we took a 6 months forward, and we took a 12-month forward. Remember, we took a forward, 3 forwards on each working day, So 21 years, there's a whole lot of forwards, 5,000 plus forwards that we had done. So what we did was, on maturity of each of the forward, we just compared the forward rate that we received with the spot at maturity. The forward rate is the rate that you get when we have done the forward. Spot at maturity is what you get if you don't do anything. Okay, so in very simple terms, it is just a simple comparison of the forward premium with vis-a-vis the rupee weakening, vis-a-vis the rupee depreciation or appreciation in that period of time. Okay, so let us see the result. The research is very simple, and ladies and gentlemen, these are all facts and figures. This is not a view. These are all facts and figures. Any one of you who wants to do an independent research can do this, can fetch market data and do this, get data from Thomson Reuters, Refinitiv, or get from Bloomberg, you get from anywhere. Do this research independently, the result will be the same. The result is not going to change. So understand these are facts and figures and not view. Next slide. So let's see what the results are. You know, for 3 months, 6 months, and 12 months, what we have seen in the last 21 years is that the average forward premium is between 4 to 4.43%. Very rightly said by Leelanand sir, it's around 4.5%. Average long term, you know, sometime it has been 8-9%, sometime it has been 0.1% as well. And on very few days in the last 21 years of history, the premiums were negative, but that was an exception, that wasn't the rule. But mostly, if you see, the forward premiums have been around 4 to 4.5% average of the last 21 years. But what is the actual rupee weakening? The actual rupee weakening has been around 2.7%. Again, hear me aloud, the actual rupee weakening, annual rupee weakening has been 2.7%. Which means if I am blindly doing a forward every day, if I am blindly doing a forward every day and the rupee continuously keeps weakening, I get 4.5%, but my risk is 2.7%. Which means by blindly doing forwards, you are gaining anything between 1.3 to 1.75% per annum. Okay, so this is a very emphatic conclusion, very, very emphatic conclusion that the exporter should regularly do forwards. The forward premiums on a long-term basis has been decently higher than the actual rupee weakening. Okay, and the conclusion is the number of times that we are successful. When I say successful, it means that the forward rates has been better or higher than the spot at maturity. So 65% of the time you are correct. 35% of the time the reverse is true, which means the spot is more than the forward rate. That means rupee has weakened more than the forward premium in that tenure. Okay, so the conclusion is if you do blindly forward hedging, exporters, if you do blindly forward hedging without applying any mind, you do forwards every day on a long term basis, you will make money. And this is one of the biggest reasons why we always say rupee is overvalued, rupee is overvalued. And one of the reasons why every 4 or 5 years there is a substantial change in the exchange rate. It corrects the overvaluation of the last few years. Okay, but long term basis, if you still see, it makes a lot of sense to do forwards and hedge your receivables. Not only is it profitable, as we have seen from historical data, but remember, it also eliminates risk. As soon as you hedge, you are eliminating risk. You are not speculating. You are eliminating risk. So you are eliminating risk and it is turning out to be profitable. Okay, so I leave you with that thought. Very critical. Understand this, and probably you should introspect and use this historical data to keep hedging. Exporters should keep hedging, and corollary to this, the importers should not blindly hedge. They should have some kind of a risk management system or some kind of a risk management guidance to hedge intermittently or irregularly, because what we have seen is rupee weakening or risk of rupee weakening is more than the is less than the forward premium. I'm sorry. Okay, next slide please. Okay, now a very simple question that comes to me by almost all MSME exporters and importers is, this problem is not there with large companies. Large companies have smart, sophisticated people, so they already know that this is a very simple thing to think about. But MSMEs are still, challenged and still, in their, Adam age conceived notion that we should continuously keep doing window forward. Now, why we suggest that window forward is not the right thing to do now? Because if you do a window forward, as Amit pointed out, you can do a window forward for the maximum of 30 days. So if you do a window forward, the exporter receives premium till the first day. Okay, so you receive premium only till the first day. And if you do a window forward for an importer, you pay premium till the last day. So you are already paying, importer paying extra premium and exporter receiving less premium. So what should you typically do is, and okay, before I move to the next thing, understand premium for 1 month, 30 days is around 25 paisa. Current 4.5% premium per annum, 4.5% annualized comes down to around 25 paisa per month. So if you're doing a window forward, an exporter is losing 25 paisa per dollar and importer is paying 25 paisa extra per dollar. Okay, so what we suggest to all MSME exporters and importers is do a fixed date forward, get the maximum premium, and if your inflow or inward comes ahead earlier than the maturity, just early utilize the forward. And when you are early utilizing the forward, you just pay back the extra premium for the number of days that you have early utilized. You just pay back in the form of early delivery charges. Okay, so getting the premium till the maximum date is very important because nowadays premiums are relatively high. So take fixed date forwards. When the money comes in earlier or you have to pay earlier, you can pay earlier and you can claim back the excess premium that you have paid in case of importers. So the question is, if fixed date forward is so simple to understand, then why was window forwards in the first place? Now, window forwards was very popular multiple years back when the forward premiums were very low. I remember the forward premiums annualized was around 60-65 paisa. So per month the premium is hardly 5-8 paisa, 4-5 paisa. So even if I do a window period, I'll only use 4-5 paisa, 5-6 paisa. But now the forward premium for a month is 25 paisa, and 25 paisa is quite a lot. So I can't lose that. So the bottom line thumb rule is, if the forward premiums are high, use fixed day forwards, and if the forward premiums are low, you can venture into window forwards for convenience. Okay, again, food for thought, please apply. Next slide, please. Okay, something that I want to touch upon specifically to MSME exporters, how to optimize interest costs on export funding. Okay, all of you MSME exporters, you are aware that you can take working capital loan in the form of packing credit, export packing credit. The big question is, what should I take? I can take packing credit in foreign currency, or I can also take packing credit in INR. Okay, why packing credit in INR? Because till 30th September, the interest subvention was there for MSMEs 5%, and for non-MSMEs for eligible codes 3%. But unfortunately, Mr. Victor, subvention is not there. So what should I do when subvention is not there? I'll come to that a couple of slides later that as well. But for example, let's just assume the subvention is there. There is a lot of talk that subvention will come back in some form of the other. When it comes back, how much it will be, we'll probably introspect and evaluate as and when it comes. But as of now, let's assume the subvention was there and it comes back in some form. Okay, so when I take a packing credit in foreign currency, I pay SOFR or ARR, as Amit just said, an alternative reference rate or a short-term funding rate, the dollar funding rate, and the spread typically is around 2-2.5%. So you get PCFC at anything between 2.2 to 2.7%, or annualized interest rates 2.2 to 2.7%. Now, if I take a packing credit in INR, the interest rates are between 6 to 8%. I get 5% subvention for an MSME and 3% subvention for a non-MSME. But it is not only 8 minus 5, 3. Okay, one very critical element that all of you need to look at is, remember when you're taking a packing credit in INR now for let's take 120 or 150 or 180 days, you're going to repay that packing credit from your foreign currency inflow that is going to come later. Okay, it's going to be an export proceed. It's going to be a foreign currency inflow. For that foreign currency inflow in future, you can take a forward contract. And if you take a forward contract, you get 4.5% forward premium. You use that forward rate whenever that inflow comes in, convert that and repay the PC. So you are effectively reducing your interest cost to negative. Again, hear me aloud, ladies and gentlemen. If the subvention is there, and if you are doing a forward contract and encashing on the forward premium of 4.5%, you are making your effective interest cost as negative. I leave that thought to you. Please think about it. In the next slide, I'll tell you how it is actually done. Dipanshu, next slide, please. What you typically do is, let's take today is the day I want to take the packing credit. I have to decide whether I take in foreign currency or should I take in INR. Let's say I decide I want to take in INR. I take 10 crores of packing credit in INR for 90 days. My trade cycle is 90 days, so I have to repay in 90 days. So that 10 crores I'm going to repay by getting my foreign currency inflow. Okay, by getting my receivable of export proceeds. I just convert this 10 crores into an equivalent dollar at the exchange rate. That comes to 1.33 million. And I do a simple forward for this 1.33 million for 3 months. I get the forward premium of 4.5%. On the maturity, when I get the receivable, I will use this forward to convert that dollar receivable to INR and use that INR funds to repay the packing credit that I have taken in INR. So doing this mechanism, your net interest rate becomes 0 to negative. Okay, very good thought. Please introspect and apply in your cases. Next slide, please. Now, everyone comes to me and tells me, Mr. Victor, now there is no subvention. So what should I do? Do the same methodology. Okay, just there is no subvention. But again, there is no subvention, but PCINR rates have come down. They have come down from what it was earlier. So just check what your PCINR rate is. Just reduce the forward premium from that. See what is your net effective interest rate. Compare that interest rate with your PCFC interest rate. And understand it is a working capital loan. It is a loan. So my foremost focus is on reducing the interest rate as much as possible on that loan. Okay, so I just take the PCINR rate, reduce the forward premium, and ensure you take the forward, reduce the forward premium, and see what is my net rate. If that is higher than PCFC, then obviously I take PCFC. But if that is lower than PCFC rate, then I take the packing credit in INR. Okay, very important for you to understand. Next slide, please. That is the thumb rule. The next slide, I want to emphasize on the thumb rule. If the interest subvention is there, then there is no brainer. You have to avail PCINR, get the benefit of the subvention, and then take the forward cover, get the forward premium. If the interest subvention is not available, you can avail PCFC, but you evaluate PCINR using the methodology that I just told you. So you have to just evaluate and see whether PCFC is cheaper or PCINR is cheaper. Okay, one small recommendation to all exporters: if you have euro, okay, I see a lot of exporters take packing credit for their euro receivables. Okay, so if you have euro, understand the euro INR premium is higher. It's 5.5%. So if you do a forward for euro INR, you receive 5.5%. So if your PCINR rate is 7%, there is no subvention. PCINR rate is 7%. You take a forward for euro INR, you get 5.5%. So your net interest cost is 1.5%. 1.5% will be cheaper than your PCFC cost, which is typically 2.5%. Okay, so for euro exposures, for euro exports, better than PCFC looks to be PCINR. If subvention is there, then it is certainly PCINR for any currency pair. But I just leave you with that intelligence and thought that whenever you're looking at working capital loan in the form of packing credit for your exports, understand the currency, understand the forward premium, check if the subvention is there, do your mathematics, and obviously you avail that loan which is cheapest to you. Okay. Next slide, Dipanshu. So that's it from my side. It's been a pleasure and an honor to talk like this. Any questions that people might have they are free to ask me.
Thank you so much, Ritesh for excellent presentation and very important as well. Now I request Vipin Mahajanji to take over. Vipinji, over to you. Sir, you are on mute, sir. You have to unmute.
Sorry. Yeah, good evening, everyone. It has been a really, thoughtful and interesting presentation being made by various people, especially Mr. Leela. He made, a speech which is very close to what has been our experience also. And a couple of words which touched me was discipline and consistency, right? So I'll just explain about knowledge infrastructure. We are primarily 100% importers. We trade in commodity and various commodities and bring it to India. And we are mainly into USD INR because all our proceeds are in INR and our payments are in USD, right? And we are almost a 20-year-old company. And it was a startup, say 20 years back, and since then we have been able to achieve certain milestones and certain things where we are proud of, right? So, and you see, we have gone through that phase where we first of all had no treasury person, and we are not foreign exchange. We were not foreign exchange experts, and we today also are not. Too much knowledgeable of foreign exchange. Only thing is we know our business, and but still, our invoice values which we have to pay are large. Typically, one invoice will be close to $3 to $5 million, and but number of invoices may not be that large. They will be, maybe around 10 to 15 invoices. But basic problem which we always faced was that when you sell the product to our customers, there will be different rates which will be there in INR. Second, there will be different payment terms which will be there. So we had to take some long maturity, we had to take basically payments and buyer's credit. A lot of buyer credit we used to do, or we are doing today, even though it is not available. So supplier credit will be there. Now, in along the journey, in the first almost 10-12 years, we from say no forex person in the company to a big treasury in the company with Bloomberg's and Reuters both over there. And then we came across Myforexeye, and it has been a pleasure to work with them for last 6-7 years. And as of today, we have saved. We don't have any Bloomberg and any Reuters, so that itself is a big saving. Even though with both of them we had to cancel certain contracts and pay some money, but still, the saving is huge on that count. Second is, today we don't have any treasury person because with complete transparency, Myforexeye has helped us. And in fact, we were always doing a complete hedging as an importer, and as Ritesh very emphatically said that we should not have been a regular hedger, even though we used to do almost 100% of hedging. So they are basically managing all our imports as of today, or you can say they are just an extension, and each and every invoice which is there, and what are the details are available to them, and they are helping us with the various options, including one of the option where they say not to hedge, right? Obviously that is based on view, but typically around 80-85% still we like to hedge, and 10 to 15% we are keeping open as an importer to take advantage of volatility, or maybe on different dates we may be doing it, including both options also as and we also do on exchange also. Plus, over and above, we have a some investable surplus cash always, because as a importer, liquidity is important for us, and there is always a liquidity surplus in the company. So that also off late we have given to them for trading, and I I can't. Sometimes I feel that instead of doing any business, I should do just trading, because the returns on the trading part is, even though it will never be consistent, I cannot say that, but it's a greed basically. That returns are so phenomenal that sometimes you feel that, why to do business, just keep on doing this. But that is not correct. So I'm not suggesting to anyone. It's just a thought which comes to my mind. And basic thing for people like us has always been that getting right people is a challenge, because for anyone who knows the business, or who understand foreign exchange, and the variabilities of this and volatilities of this, they are first hard to find, and second is hard to retain. And that is where we started with maybe a little bit of part of the management to Forexeye. And over the years, maybe 4 years back, actually, we totally outsourced our treasury and forex management to Myforexeye. And Ritesh has been, very, very efficient in that. If I, on a ballpark figure, I think we must have saved close to around $3 odd million in this last 5 to 6 years. And at a very, very nominal fee, even though, when we started, so we thought, why are we paying so much money? But then we saw that the salary costs are higher than what Myforexeye is charging to us. So it has been a very, very wonderful experience so far, and hopefully in future also. And now presently I keep on using the app also for my personal trading also on the currency. So the app is, really, I should compliment them on the app, basically. So I think that's it for me. That is our experience with Myforexeye.
Thank you so much, Vipinji. Now I request Abhinav Gupta ji to take over. Abhinav ji, over to you. Abhinav ji? I can see you, but I can't hear you. Okay. Okay. Abhinav ji, otherwise we can close this session if we can't hear you.
Abhinav,
Okay.
can you? I think he is there, but he's
Yes,
is muted.
yeah, he's muted, I think. Okay, now Sushil ji, I would like to bring you to share. Okay,
I think
Abhinav ji
Mr.
here.
Abhinav is there. Yeah.
Yeah. Abhinav ji?
Abhinav, we can see you, but we can't hear you.
Ritesh, can you hear me?
Yes, now we can hear you.
We can hear you. Yeah, go ahead, please.
Okay, I don't know why I am not able to hear your voice. It's coming very slow to me.
Is it
anyways,
okay
now? I think that's fine. So I think Ritesh ji has been sort of our consultant on Forex as far as I remember. So that's pretty long. And the good thing is that I think Ritesh has always been the first to guy. You go to him whenever you feel any consultancy is required on Forex. We are basically an exporter. But at times like this, when we are undertaking expansion programs, then obviously it's both ways, exports as well as imports. And we do have, since it's a pretty large company, we do have a couple of consultants advising us. But as I said, Ritesh is the first go-to guy. And his views are very logical and supported by data. So you feel that there is a lot of conviction, both from the technical side, both from the fundamental side, and when you interact with him, he comes across as a very, very knowledgeable person who has his feet to the ground and is aware of what's going on. So Ritesh is, as I said, many congrats. I see a lot of people here in this webinar, And obviously, everybody is speaking highly of you, and certainly, I would say ki, whatever we say is less as compared to what you have been performing for us. So thank you very much, and wish you all the best, and let your business grow as much as feasible. Thank you.
Thank you, Abhinav. Thank you for the great words. Thank you so much. Thank you.
Now, Sushilji, over to you.
Thank you, Mr. Nahid. It has been a wonderful knowledge session on involving trends and significance of Forex management for MSMEs. Managing risk is a very important aspect of managing business, and managing Forex risk is a very important part of financial risk management for any MSME that is exposed to Forex risk. I thank all the speakers for expressing their views on it and highlighting how much important this is for MSMEs to actively manage their profitability by managing foreign exchange risk. Banks and financial institutions also have to play a very important role in educating the MSMEs about the various tools available for managing the Forex risk, and training them and actively telling them to do all the transactions of import and export only by using the hedging tools. With this, I actually conclude my closing remarks, and over to Mr. Nahid.
Thank you so much. Now I request all of you to switch on your camera so that I can click a photograph. Dipanshu, you need to switch on your camera. Naveenji, Vipinji, Abhinavji, if you can. Okay, fine. Okay, thank you so much, all of you, to joining this wonderful session, and hope it will be a ready reckoner for MSMEs, and we will keep you bothering you for further sessions as well, because these sessions are very, very important for MSMEs. Thank you so much. Now we are closing the session. Thank you all.
Yeah. Thank you, everyone.
Thank you.
Thank you so much. Thank
Bye.
you.
Bye.
Bye-bye. Take care.